Is it possible to use probability in trading, and how can someone do so? With various examples, we're going to discuss probability and explain why you need to have a good idea of how it works for trading. I'm unbiased trading, and I'm currently heavily using probability in all aspects of trading, both discretionary and in algos. Let's dive straight into this topic. What is probability? Have you ever felt uncertain about trading certain ideas or strategies? Well, I have some good news for you. Probability is an amazing tool that you can use to make better decisions and deal with all that uncertainty. Probability is the study of events and outcomes that involve an element of uncertainty. Just like tossing a coin or investing in the stock market, there are always fluctuations and unknowns. For example, after a gap, meaning a stock is considerably higher than the previous close, there can be considerable fluctuations in the stock price. But with probability, you can get a better idea of the chances of the stock price going up or down. And this allows you to create a bias of building foundations for confidence and conviction using this historical or probabilities. Let me give you an example. Let's say the historical probability of Snapchat stock rising post positive earnings announcements is 80%, while the probability of it falling is 20%. With this information, you can make a more confident decision and increase your chances of making a profit, as you could easily identify if it's more favorable for long strategies or certain trading ideas on that particular stock than shorting it after that given event. Now, what is the actual probability formula? Using the previous example, let's say over 100 earnings of Snapchat stock's price movement, and 80 out of those 100 earnings, the stock price continued to rise for the day after that positive earnings. So if A in this event is the stock price increasing, the probability of that event is 80 out of 100, which is 80%. This is an extremely basic example of how you can use probability and how it will be calculated, but this is the foundation of what probability is. Now, there's a couple types of probability. Now that you've gotten a good grasp of what probability is and how it is calculated, let's dive into the different types of probabilities. Understanding these can really help you make more informed decisions. There are two broad categories of probability, subjective and objective. Subjective probabilities is based on personal or subjective judgment and can vary from person to person. For example, during the 2008 financial crisis, not many people predicted the housing market crash, but those who did made a killing while the rest of the world suffered. The probability of this event was different for each person based on their own personal subjective opinions. However, there was also data kind of backing this up, so this can be a mix of subjective and objective. On the other hand, objective probability is not influenced by personal biases and can be calculated through experiments and observation and data. One common way to estimate the probability of an event is by analyzing historical data. For instance, if you notice that the Tesla stock price tends to increase after Elon Musk tweets, you can objectively deduce that there is a high probability that the price will increase or decrease from this event historically if you analyze the historical data of both. Probability distributions. Now, we all kind of know this classic example of finding the probabilities of a dice roll. There are only 6 outcomes on a dice roll, which are 1, 2, 3, 4, 5, 6. So the probability of rolling a 1 is 1 out of 6. This type of probability is called discrete, as there are a fixed number of outcomes. If we list all the outcomes of a given event, it is known as the probability distribution. For instance, the probability distribution for the dice roll event would be as shown on the screen. While listing all the values is doable for a limited set of outcomes like this, it is not practical for larger outcomes, and instead we will use functions for that purpose. If the probability is discrete, the function is called a probability mass function. In this case of a dice roll, the probability mass function would be P open brackets x close brackets equals 1 out of 6, where x is the either 1, 2, 3, 4, 5, or 6. For discrete probabilities, some cases are extensively studied and their probability distribution has become standardized. Bernoulli's distribution is an excellent example of this, as it takes into account the probability of getting heads or tails when tossing a coin. The probability function is px open brackets 1 minus p close brackets open brackets again 1 minus x. Here, x is the outcome, and heads could be written as a 0 and tails could be written as a 1. However, when there is a change in the returns of a stock within a particular range, there are an infinite number of other valid values between those two values. This becomes accurate measurements and can only go to a decimal place, and the returns of a stock, for example, is a continuous random variable compared to this one, which is just discrete. Distributions. This is also where distributions come in handy. So if you'll take a look, you'll see that the distribution of Amazon's daily percentage change using adjusted price data of the stock has this classic bell shape. It's called a normal distribution, and it's got two important parameters, the mean and the standard deviation. Basically, most of the data is hanging out in the middle, and the mean is like the dividing line between these two halves. If you're wondering what this all means for actually trading, think of the mean as the expected change in the percentage for the stock, and the standard deviation, well, that's the level of risk you're taking on. Since our returns are normally distributed, we can use some math magic to figure out the minimum and maximum values, or even the range for the returns. And that means even unlikely outcomes become a bit more likely. Probability is a mathematical concept that can be used to apply in all domains of trading. All great traders use probabilities to some extent, and they will even create intelligent and well-designed trading strategies and refined decision-making all using probability. So hopefully this video has helped provide a foundation for you, or been at least a refresher. Thank you for watching, and if you enjoyed it, please like and share it with anyone else who might be interested.